Good afternoon, everybody. Welcome to our Trading Index Options webcast. I'm Connie Hill, and I join you every week at this time, and happy to do so. Glad to see so many of you here. We've had a lot of interest in zero DTE options. If you're like, I don't even know what that abbreviation stands for, Connie, we'll get into it. Had a lot of interest in it. Last week, we started down that path just a little bit, but we didn't get very far. So we're going to kind of rehearse the little piece we did last week and then go further down that path. I'll show you some zero DTE option trades that I did today and just kind of what the rules were, so that if you're interested in that type of trading, it'll at least give you some ideas of where to start, right? You could have 100 different ideas of how to do certain things. All right, I hope you follow me on X. I'm Connie Hill, CS, and I'll post educational content out in my X account throughout the week, throughout the trading day. We have the pleasure of having good friend and fellow coach Barb Armstrong with me here today. I should say with us, all right? And she and I will both keep our eye on the chat. If there's questions that maybe I can't quite get to, Barb will help me out there. But we do want to know what your questions are, so let us know. If you're listening to this on the recording, like lots of you do, when you have questions, go ahead and write it in the comments section in YouTube, because I go back every day and look at those comments so that you can get your questions answered as well. And it's one way that you can communicate with us. That sometimes people are like, I want to communicate with you more. That is another way to do so. All right, let's go through our disclosures and get down to business. What we talk about today is intended for educational and informational purposes only. Do not consider it a recommendation. Past performance is no guarantee of future results. We mainly work with the European style options here. American style options can be assigned at any time up to options expiration if it's in the money, regardless, I should say, regardless of the in the money amount. With European style options, and that's one reason we're interested in them, they cannot be assigned early, which is helpful when you're a seller of premium. We talk about probabilities here today. Keep in mind they're theoretical in nature. When you're talking about trading options at or near expiration, like 0 days to expiration type options, keep in mind there's some additional risks that you want to be aware of. Could include lack of liquidity, significant price slippage, volatility. Profits can disappear very quickly. Opening an options transaction on their expiration date, which is the 0 days to options expiration. Trading significantly or substantially increases your risk due to limited timeframes and the need for monitoring. We'll talk about that today. There's no guarantee that execution of a stop order will be at or near the stop price. That's going to be important because we will be placing some orders like that. We will be using the Paper Money software application. I think it's a fantastic tool for you to test in. Now, I've got a question for you, and I want you to answer it in the chat here for me. How many of you have experimented or have traded either in your live account or paper account any options with a really short date, like using today's date, the ones that expire today, or maybe even the ones that expire tomorrow, that are just super short time frames? In our class, we've done one weekly where we go out 14 days. We're going to continue that trade, but I'm just curious to know how much exposure you have to the other, since it's something that has been requested quite a bit in this class, which makes sense that we talk about it here in this class. So let's go to our charts here. Okay, so we've got I have, never, me. I don't know what me, if that means yes or no. Never, no. Okay, Ricebird's done 0 and 2 days to options expiration. Yes, no, yes. Okay, we've got a variety here. Some of you have been experimenting around with it and you're looking for ideas maybe to fine tune your process. And then there's others that have never even touched it. So maybe this is going to be a new topic for you. Okay. What we're going to do is go back, touch on a little bit from last week, talk a little bit about those templates. They gave us a little bit of problem last week. So and it didn't work for some of you. You were trying to do it alongside with me and you were getting error messages. I've done a little testing out today and it looks like those types of error messages that it was giving to us are not happening. So I think things are back the way they need to be. So let's move forward. Last week, I'll tell you what trade we put on. We put on a trade using this daily chart and using the market forecast and the moving averages here of a 20, a 50, and a 200. And our rules at that time, and what we've been doing over the last few weeks, is we've been looking to go bullish. And so if the price of SPX is above the 20 period average and the 50 period average and the 200-day moving average, which it's been above it for a long, long time, then we said we're going to do a bullish trade on it. We added some additional criteria in that we said, plus we want to see from the market forecast study, which is the bottom one, we want to see that blue line rising, or if it's not rising, be up here in the upper reversal zone, which tells us that buyers are currently in control. They stay in control until the line comes out of that upper reversal zone. The other time we would consider doing a trade is if the blue line is really low down in the overbought area or oversold area. If it's 5 or less, how much further could it go down? Can't go much further. 0 is the very bottom. It doesn't have negative numbers on it. And so we've said if it's 5 or less, then it's likely to possibly rebound quickly. And so we would add that condition in there as well. Okay. Ricebird says, I have 14 days, which is about to become 0 DTE, meaning I think you sold it when it was 14 days out, and now it's maybe going to expire today. That could be the case. Okay. Next up. So that's kind of the rules that we were working with. We put in a trade in our class, and the rules that we are using is this. I kind of scooted down just a little too far. We can see it here. We buy 14 days out. We use the probability of expiring cone, and we go 14 days out, and we see where does this cone lie in terms of probabilities 14 days out. Remember, this cone represents a bell-shaped curve. And the bell-shaped curve, we could have it go out. I have this one going out 30 days. The default is 100 days. If you put it on with 100 days, it flares out even further on the top and further on the bottom. And the first 30 days will look identical to this. Okay, so that period number isn't going to change the way that the cone looks. Okay, and it's set up to bring into these two areas 1 standard deviation. We're getting a little bit technical. We're getting into some statistics here. So it's called the probability of expiring cone, and it's letting us know what's the probability of this particular price of the index going beyond these boundaries of the 1 standard deviation on a bell-shaped curve. How do we know it's 1 standard deviation? We know from this little number here that's 68. And on a bell-shaped curve, if we took the mean down the middle and went out 1 standard deviation on either side, we'd be going 34 to the right, 34 to the left. Okay. And that represents 1 standard deviation. If you were to do 2 standard deviations, which we're not doing, but you change that number, and I think it's going to be like 95.6, I think is the correct number to be exact. Okay. So just a little bit there about that probability of expiring cone. We could have some of you that are just maybe joining us fairly new and haven't been around in previous weeks to hear these discussions. Okay. So if we were going to do this trade today, let's go back to the screen for a minute. It's a little hard to tell here because I've got some marks here for some things that I've done today that I'm going to show you. But right now, SPX is above all those moving averages. The RS line, or the market forecast line rather, is headed up, that blue one. And so it meets the condition. So step 2 would be going to the probability calculator, or not calculator, probability of expiring cone. And let's see, if we go to here for just a minute, if we go out 14 days, that would be September 9th. So we're going to go out 14 days on the cone and put a little mark. All right, so down at the bottom, you can see I have dates coming out. September, there's September 8th. September 9th is right there. And I'm just going to put this little mark about where it goes through. And I'm going to put my mouse as close to being on that line as I can. That looks like it's at about 74.61. And so we'd want to sell a strike price that's lower than 74.61, because then that means it's outside of the probability of expiring cone rather than being inside the cone. Inside the cone is where it could land. We want to sell where it's not likely to land. Now, it's never guaranteed that it's not going to go there. It's just that those are the probabilities that we're looking for. So if I put my mouse back on here, I said it was like 74.61. I'm getting 74.62. Something like 74.60 would be just barely out of that range. Let me grab a pen here. 74.60. Could you go further than that? You could, but for our purposes, we're just kind of barely going out. All right. Next step is, what kind of a trade would we want to put on? We're going to do a spread trade. We're going to do a short vertical, and the bullish version of the short vertical is a short put vertical. Okay. So as we come back over here, let's see here. Let me see if I need to clear up something before we move a little bit further. Perhaps show the options expiration on Fridays can be turned on. It could be MBH. However, you could turn it on if you wanted to, but we're using the 14 days because that's the day we meet in class. And if we're still in the trade when we have our class again, we're going to close it down. We're not going for the expiration Fridays, but you could if you wanted. But the unique thing with the SPX is we've got them. Look at this. We've got them almost every day as we go out here, right? You can see those numbers represented. Just kind of going out here. All right, so the trade we've been doing is 14 days. Ted says, since you use a 1 standard deviation cone, doesn't that equate to a 16 delta approximately? If so, why not just look for the 16 delta option instead of using the cone? That's a good observation, Ted. What I have noticed isn't always 16, but it falls in a little bit of a range. We've had it be 14 before. We've had it be 15. We'll see if it's 16 right now or where it actually lies. It also depends a little bit on where you are in the day trading. If we're towards the end of the day, like we are in our class here, that might be a little bit lower, that delta, than say if I were doing it first thing in the morning. Now, if you just want to say, hey, I'm going to pick a 16 delta, I don't have a problem with that. But we're going to use the cone. All right, so we're going to come out here. I've got 120 strikes. We probably don't need all of them. And again, we're going to say, all right, 74.60 is below the probability cone. Would you look at that? It's a 14 delta. Ted knew it. Ricebird knew it. Yeah, it very frequently has been in our class, but not exclusively. Okay, and you can see here, there's another 14, there's another 14. Again, since we're using the cone, we're going to go to the 74.60, which has been around 13.14. It's moving around right here. Now, last week we built a template, and I was testing out using our template today and just making sure it worked really good. And I found that I had some success in that area. I also found I had a small error in one of the ones I created, and I don't know if it's one we created in class together or not. I did mention to you that some of you, as you were trying to create this alongside me, were getting error messages. And so if you want to try it again, we'll go through the steps here of doing that again. Now, I'm going to say the steps have to be performed perfectly, and you have to do it from scratch. Okay, what do I mean doing it from scratch? Means you could not come out here and say cell custom with OCO bracket, even though we're going to construct an OCO bracket. For some reason, at least in my testing that I've done, it doesn't allow you to edit it the way that you want it. Okay, and so what you do have to do is you can just say cell, we'll just say cell vertical, and then we're going to go set up the parameters. Okay, the idea here is if you do the same thing every time, then you build a template so that it can just save you some time getting your order in, having your exit points where you want them, and just kind of getting it in pretty quickly without having to dink around. Okay, that's probably not a real official trading term, dink around. All right, but typically here we're going to go 20 strike prices wide. Okay, so if we started at 74, oh, it took the 74.70. It must have shifted on me a little bit. I've got to go to the 75.60. So we'll say cell vertical, make sure I've got the right one. I guess we could have done the 74.70, but I'm going to try to be as pure as I can here. And then if we're going to sell this one, then we're going to buy the 74.40 as our hedge lag instead of the 50 that it comes up with. So here's 74.40, and it's about $1.60 credit here. Now, because I want to go through the process of building the template and then we'll test the template, we're going to construct it manually here. First step is we're going to say we want to first triggers OCO order, meaning this order has to go in before our one canceled other orders go on. We're just going to do one contract here. We're going to say create opposite order. We're going to do that twice. And then we're going to try to build this so that you don't have to go through and calculate any numbers, that will let the system do it for us. So our first one that we're going to do here, we're going to do as a limit order. Our second order we're going to do here, we're going to be doing a stop order. And over here in this column that says link, we're going to click on man, and we're going to change it to TRG, which means trigger. All right, so both of these, we're going to change to trigger. One of the things I noticed in my testing is that if I did up in here, first triggers OCO bracket, it would not give you the choice of bringing in trigger. And you're like looking around for it. You're like, it should be on the list. Where did it go? So that's why you say you have to do every single step from scratch. And I don't know if I reiterated that very much last week, but I do want to today. All right. Our trigger for our profit, we're going to calculate first. And our trigger for our profit is if we get 50% of our target, our max gain, if we get 50% of it, we want to be out. So we're going to configure this to relate to that. So we're going to click on this little icon here. It comes in as a plus and a minus, and click on it twice till it gets to be a percentage. And then we're going to put in here minus 50%. And basically that means whatever this value is. Right now it's 165, but you might use it again. It's a different value. It could be 180, $2, whatever, right? We're going to say when we get 50% of this, get us out of the trade. Then we're also going to put in a stop here. On these trades, I kind of feel like putting in a stop loss is really important because we're risking a lot more than what we have to gain. We're putting on a high probability trade, but if it goes against us, what's our max theoretical loss? It's going to be the strike price difference here, $20 minus $1.60 or $1.65, whatever it ends up being, right? So we're looking at losing like in this one, $18.45 or 35 cents. That's a lot, right? And so we want to avoid getting to that place at all. And so we've said, all right, if it gets 2 times our profit on the other side, so it's a negative 165, then we want to be out, okay? Because it would be wiping out our whole credit and it would be going against us that amount. And that's why we're going to do this. And so we're going to do the same thing here, make it a percentage. And in here, we're going to put plus 100%. Now, I'm going to tell you, this template is going to work for us whether we do short put verticals or short call verticals, okay? It embeds the logic in it, all right? Make sure these are both good till canceled, and that's our template. To save the template, click on this icon just to the left of delete, and it's going to come up with a name that you don't have to keep, or if you like the name it comes up with, great. I have some with the original name and then I kind of overwrote on it. However, for this one, what I'm going to do is I'm going to call this index, because you could use it with the SPX, you could use it with any index you might want. And you don't even have to use it with an index, you could use it with something else. But on our indexes, we're going 20 wide. Maybe in stocks, maybe you're only going to go 10 wide or 5 wide or something like that. So I'm going to call this index plus, or actually, we're going to go minus 50%. So we get 50% of our gain. We're going to be happy. Plus 100%. And then I'm going to say OCO. And I might have one called something similar to this. So I'm going to put an X on the end. Okay. So it's a unique name. If it duplicated that name, it would come up and you could say you want to override it if you do. Okay, but that's what we're going to call it. So it's going to look like 0 Cox, but it's OCOX. Maybe I should just put a little dash there. All right, that's the name of it. Whatever you name it, it doesn't matter. Just remember what you name it so you can go find it again. There is our template. Okay, I'm going to delete this. And we're going to go out to our 7460 again and now go use that template. So right mouse click, sell custom, and then you're used to these guys being here. And when you create templates, they start showing up here. So remember, I called this index, and I called it this one, minus, oh, I forgot to put 20 wide. I kind of want that name in there. It's okay. This is what I call it. Index minus 50% plus 100% OCO-X. That's what I called it. I'm going to select on it. And then it's going to come up. And you're like, if you like to do the same thing every time, it's great. Now it's looking like this is up to about $1.70 credit, which means maybe possibly the stock is pulling back a little bit, or the index here, because that's value's going up a little. But it met our rules. We're going to go ahead. We're going to send it off. And I'm going to put it in our group that's called Weekly Index Options for our class. Now I'm going to check and see if there are any questions before I go ahead. I'm going to send it in, and then if we need to come back and address something, we can. Yeah, Riceford says, you know, you found it pretty consistently being around a 16 delta, plus or minus. Yeah, I don't have a problem with that whatsoever. Okay, in fact, our linear regression model that we're not really going to get into here today, we were doing that. We had said sell a 17 or 18 delta. Okay, still far out of the money, still higher probability. We didn't get filled on this, so let's take a look and see what's going on. Oh, it only wants to fill us for $1.60. Maybe it'll go to 65. Because I want it to fill for our purposes here today, I'm just going to cancel the order, or not cancel, I'm going to do a cancel replace, click the lock, let the 160 go in. If I really, really wanted to go in, you could do it for 155, but I think it'll fill us here on the 160. All right. Now we have our trade for right now, based on those rules and doing that template. So hopefully those of you that had issues with that template creation last week, hopefully now you're like, oh, good, that was easy. It worked. It didn't throw me error messages. Okay. If you have a question about it, let me know and I'll circle back. Next up, I want to talk about these 0 days to operate, 0 days to options expiration options. And we're going to come up here on the SPX, and I'm just going to open up the ones from this week. And I shouldn't say this week, today, the ones for today, because it expires today. As I scroll down here a little bit, I want you to see what the open interest is here. I want you to see what the volume is here. Okay, so this morning, this 7665 had 1,300 contracts, and there have been 132,000 contracts added to it today. The delta's 0.03, so it's out of the money. And what we might see is a lot of out of the money options are where we see a lot of activity. Probably this volume activity here today, probably I'm going to say is likely to have happened earlier in the day, because right now, look how low that is, 0 by 5 cents. Okay, so probably earlier in the day, there was a little bit more time value in there than there is right now. Okay, Ricebird, you said you had an error at first, but then you went back and reviewed it and fixed the problem. Perfect. See, giving you a little bit more exposure. Yeah, definitely helps you feel more comfortable doing it. Okay. So the bottom line is there's a ton of contracts out here. And because the theta value is higher because it's expiring today, that gives you the idea of maybe you could sell some premium and maybe do multiple ones throughout the day. Now, last week I exposed you to the rules we're going to look at here. We're going to head over to the chart. We're not doing anything with linear regression today, but I am going to come back over to one that I used earlier today. And this is, it has this blue line is a 21 period moving average. The red one is 50. And this green one clear down here is a 200. So somewhat similar. Then the bottom study, it's not the market forecast, it's the RSI. So I'll show you what the rules were that I used today, and I'm going to show you my entries and exit points. Because we're going today, the sample example trades I used were 0 DTE options. We might want a faster chart than a daily chart. Okay, you might get to decide where your comfort level is. Okay, if you feel like you want, say, a 5-minute chart, here's a 2-day 5-minute. You could use that. Notice the blue area is what happened today. This gray area in between those days, remember this is kind of extended hours trading type things. There's not a lot of activity that typically takes place there. In any case, this is what this has done today. So early in the day, it was up, then it pulled back. Then it kind of was being a little zigzaggy, you know, kind of in that upper range, but above those moving averages. And then later this afternoon, man, it really dropped down here. Okay, and then of course, since then it's recovered. Now, before class started today, I placed a trade on, let me just, I should have cleaned this up a little bit first. Let's go to our unallocated. I have a few SPX trades here. And there was one I did right before our class that has 14 days to options expiration. This is using our chart with the first rules. I need to clarify that. So I used the daily chart here and saw that it was above all those moving averages and the RS, and that the blue line was headed up, that near term line. So I went ahead with the trade, went 14 days out, and let's just kind of see where it's sitting right now. We collected on it $1.60, and right now it's at 165. So we're down on this particular trade that's in there right now about $5. So not a big deal. It just hasn't moved a whole lot yet. Okay, but we have 14 days, and we used that same template on it so that if we get 50% of our 160 and it can sell it, you let us buy back the spread at 80 cents or something better than that, then we've told it to do that. And if it goes the opposite direction, and it goes against us 100%, then we're going to get out on that side. Okay. But earlier today, I used this other grid that we're looking at here. Okay, let me go back here. I'll share this with you at the end of the day, or the end of it in a few minutes. I'll also post it out in the notes when I do my post WebEx work. Okay, I'll put a link for this new grid. And because it was 0 days, I was using, instead of a 5-minute chart, this is like really aggressive, using a 1 day, 1 minute chart. Okay. And I'm going to zoom in on where I started doing some trading on this today. Let's see. I marked it, but I am not seeing my marks in here. I put a green where I got in. I put a red where I had to get out. Let's do this. Let's go to the account statement. And I've just said, show me my trades. This was last week's trade. Show me my trades from today. Okay. So the first trade that we put in looks like it was at 9:21 my time, which is Mountain Time Zone. So almost 2 hours after the market opened. Okay. So let's go look at this. We collected a $1.40 on it, and I was testing my template, and it didn't work. It didn't get me out where I thought it was supposed to. And there I found an error, which I was going to show you, and I'm going to point it out to you so that if you did the same thing, you can fix it. Okay. So I was expecting, if this was going against us, $1.40, instead of gaining 140, that it would have triggered my exit, and it didn't. So I had to kind of dig in and see what was going on. And the error that I found was that instead of doing plus 100%, I had put plus $100. I forgot to click on that little icon. It starts out with the plus minus. I have to click it twice to get it to the percentage. That's what I had done wrong in my template. Okay, so I went back and I fixed it and I tested it again. All right, this one I had to manually get myself out of. So a few minutes later, I put on a new one. We brought in a $1.25 credit. And how long after that is? Maybe about 20, maybe not even a half hour here. It did what? It stopped us out. Did it stop us out where we would like it to stop us out? Well, we brought in 125 credit. We were looking for it to go against us, that amount, and then trigger an order. And so, yeah, it triggered us out here. We had to pay $255 for it. That's pretty close to $250. Okay, $255. Remember, on those orders, it triggers a market order, but we're not guaranteed a price, right? It just goes in and gets us the next fill. So I traded. It met the condition again, went above all those moving averages. My RSI line was headed upwards. So we put in another order. This time we did a $1.45. And it was, I don't know, 20 minutes later, maybe almost 30 minutes later, that it did what? Met our conditions to get out. It said, okay, we can go buy this back for 70 cents. It probably, I don't know, basically half that, or going against us by half that amount, right? Or having the spread drop in our favor, so we could go buy it back and say, okay, instead of keeping 145, we'll buy it back for 70 cents and keep half of it. Okay, so then that one went in. Okay, and then I did the one I already showed you that is 14 days to options expiration. Okay, these are all, you can see today, they're going to expire here today. Now, how quickly did those trades go? Well, we put on 1, 2, 3 of them with the 0 days to options expiration, and I wasn't in a position to be able to do it a lot today, but I did get 3 trades on. Now, people that are selling these spreads are hoping to be done with the trades quickly. They're not guaranteed it's going to be quick though, right? Just like this one here, it could take a while. There's nothing that says that it will go quickly. Now I'll show you the extra rules that I added to this, okay? And if that first trade was at 941, right? 921. I'm going to find 921 here. 920, 914. Here's 921. But I am not seeing my mark on here. And actually, I would have wanted us to be above these moving averages. So something's a little bit off here. I'm not sure what it is. Now, let me just see if I have any other ones. I'm not seeing them. And this is a 1 day, 1 minute. Okay, let me tell you a couple of other things I considered. Okay, one, I've got my exits. If we get a profit, get out. If it goes against us, get out. That is sitting there ready to take over. And you saw the other trades I did that it did, right? The other thing we could have done is we could have said, well, where is short-term day support, day resistance? Where are some of those levels? And I had written those out here too. I'm not sure what I did to erase all of my markings, but I did something. But as you look at this chart, can you see some support levels for the day and resistance levels? I was noticing one about right here for the first part of the day. That looked like it was a support area. How about over here? Maybe on the top here a little bit, getting up here to what, 76. Well, let's go about right there. 76.82-ish, okay? And so something that you could experiment with is if it makes a technical violation that you're not comfortable with, but it hasn't hit your stop loss yet. Like say it violates, oh, we just got filled on something. If it violates something that you're like, I really want to be out. I know my stop loss isn't there yet, but I want to be out. You can override it. There's nothing that says you can't do that. But you'd want to do it for something you're seeing in the chart, some violation. Oh man, it broke through resistance. Well, did it break through it a long way or just a short way? Is it a dinky candle that's just kind of borderline, or is it a big candle, right? So maybe something through here, you're like, well, it penetrated, let's watch it. Oh, it went back down again, penetrate it again. This is a little bit bigger candle. And, and then by the time you get this candle, you're like, okay, it's looking strongly that direction. So if it hasn't hit the stop yet, you could consider saying, okay, I'm going to just manually adjust that exit and get out and try to minimize the loss. Now, one of these trades I did do, and I didn't point this out to you, was a call vertical. So most of these were put verticals. This particular one was a call spread, this one that we got stopped out on pretty quickly. Okay, again, I used the template. It worked going using the call side of things, not just the put side of things. All right, let's take a look here. Where would you find the post WebEx links that I'm talking about? Yes, let's show you, okay? I'm gonna head over to, let's come over here, and I'm gonna come over here to our Trader Talks channel. Now, when you are a subscriber to our channel, it makes it really easy to find our content, okay? And so what you would do, you'd come over here to the playlist, and you could put in the name of a playlist like, this is called Trading Index Options, or you could put in any topic. Okay, so you're going to see here is our class going on right now. Last week's class, I had called Save Time by Creating an Index Option Template. I'm just going to go into here and show you. So if you were looking for those comments, you bring up the video, and then you can see down here in the comment section, different people have asked some different questions, but where I put the links that we share with you, like in this case, we're sharing a template with you, but remember, any script or formula we share with you isn't guaranteed as to accuracy or timing. And let's see where I put it exactly. The index options. Oh, here's the index options grid from last week. I'm going to share the new one with you. And so I'll put index options and I'll add on a fourth chart here, which is the new stuff that I was using today for the 0 days to options expiration. Let's see, these are previous webcasts. So it's really down in here is where I will share that grid. Okay, so this is where last week's was. It won't have on the new data from today. And I said I updated this if you were using an old link previously. Okay, so basically pull up the webcast, and then you have to click on that more so that it expands and shows you all of the additional information in here. Okay, this kind of gives you a summary of what our class was. Make sense? All right. Let's see what other questions I need to clear up here. I think we're pretty good. Now, Barb's sharing some links with you for X. Would love to have you follow us on X, Connie Hill CS, Barb Armstrong CS. And she is also, my LinkedIn is having issues right now, but I'm hoping to get it squared away. So my LinkedIn goes, I don't know where it goes. It goes to a different Connie Hill in Denver is where it's going right now. So I'm trying to fix that up. All right. But Barb's out there as well. Lots of good information that we're posting out in that social media. Now, those of you that are interested in trying the 0 days to options expiration, you know, you could experiment with this or any other rules. Like I said, I used a 1 day, 1 minute chart, which is really aggressive. You might not want it that fast. You might want, you might want a 5 minute chart. You might want a 15-minute chart. You might say 0 days, it scares me, I don't want to do 0 days, and you want to choose another increment. That's fine. Okay. What I want you to get comfortable with is the idea that having taking out some profits when you can, like that 50% or whatever percent you like, right? And making sure that you've got a stop in there so that you're trying to avoid that situation of taking a max loss on these trades, because one max loss could wipe out a whole bunch of gains. And that's why we want to be really careful with that, and why in this template that we've built that in there. And again, you'll put in your parameters that you feel comfortable with. Okay. Rodney says, with the market forecast strategy, do you still get out at 7 days regardless? The answer is yes, we'll still get out 7 days regardless. If we are still in that trade, come next Wednesday, we're going to get out of it, either maybe at a somewhat of a loss or somewhat of a gain. Would have to see what it would be. However, if it gets us out before then and it still meets the rules, feel free to put on another one. Right? You might end up putting one on every single day. You might not either. You might still be in the trade for a few days. But feel free to say, okay, I'm out of one. Let's ladder in. Let's go ahead and get another, whatever meets the criteria at that time. All right. Good question. All right, you guys. I know we've covered quite a bit, but I'm going to say, go ahead and do your own experimenting in paper, right? Some people have said, hey, I really like James Boyd 10 and 20 whole moving averages. If you do, test it. See if you'll like using it in that kind of a scenario too. We probably won't do any testing with that model just yet. Okay, but just know any kind of rule structure that you're comfortable with, that you like, and you might want to put into a faster forecast, you could go ahead and do that. All right. Remember, 0 DTE is not for everybody. It might scare the daylights out of some of you, and that's okay. You don't need to go near it. All right. Barb, thank you for your help here today. Thank you to each of you for being here. and being engaged and having the kind of questions that you've had. If this is helpful to you today, hit the like button on the way out. That will let others find the webcast once it's up for archived, or once it's become archived. Follow Barb and I and subscribe. Those are all your to-dos for the moment. Now, coming up next, going to be, and I think Barb has it listed right there in the chat, Stock Investing for Beginners. This was a little bit more of an advanced class. Scott's doing a fantastic job in investing for beginners. A lot of you like going to that class as well. So we'll follow up on how those trades are doing this coming week. We'll see you then. Bye-bye.